All right, guys, good morning again, and welcome to another one of our TED Talks. Kidding. So today we're going to talk a little bit about intermarket analysis and how I blend that into my trading. So I don't necessarily look at correlated pairs like, one sec, thought everyone was muted. There we go. So traditionally, the information I got was that if you're looking at EU-GU, you would look for what's EG doing and then make a decision based off that. And if you're like me, that's something you've tried multiple times, made some good trades using it, and also failed using it. All right. So from my, I don't want to say desperation, but from my tired of losing, I looked at the markets, looked at actual correlated pairs, what was in the market, what was happening, what was there that could have told me that the market was doing something before it did it. And what I found was that if you're looking at correlated pairs like EUGU, let's use EUGU since they're so popular. If you're looking at correlated pairs like EUGU and you're trying to decide how to trade them both using correlated analysis without looking at EG, you can take a look at the highs and the lows, kind of like SMT, but not SMT. So let's take a look at what's been happening across all these pairs and why I've been saying stuff like we're likely to see them trade back inside this right here. And I guess just for completeness sake, I'll throw EG on. I don't have it here. Control U. EG is somewhere. I don't see it. It should be here. So ECN2, yeah, should be in this. These are the zero spreads versions. So let's take a look at EG, what it's been doing recently, and check to see if that was aligning with what's happening here. Go clean charts, daily charts. All right, so looking at EG, we can see that there was a huge bullish impulse that started on the 25th of August. If you're looking at correlated pair analysis and you're bearish both EU and GU because the XY is bullish, 25th here, we have, one sec. '25th is this day. So for EG, on this day, we had a huge bullish impulse that took out daily highs, which is suggesting at that point in time that Euro is stronger than GBP, right? Or GBP is weaker, depending on how you want to look at it. So if you're looking at GU and EU at this point in time, while they're both expected to be falling, and this is the lowest closing down candle on EU, at the lows when you expect EU to be consolidating, EG is suggesting that while EU is consolidating, this is likely to continue going lower. So we have that right here. Now, let's take a look at the actual low on this guy right here, and look at when it was taken. And that will give you an idea of how you could have seen this weakness way before EG started showing it. So right here, we broke below on that day, the 22nd. On the 22nd, GU was taking lows, and on the 22nd, I want to say it's this as well. This was also taking lows, all right? Now, if you take a look at the closing prices at the lows, we'll have, stay the line off. Look at this candle and look at this candle right here. So, one sec. Just admitting some guys. All right, so when you take a look at this, we have both pairs moving down considerably. GU has created gaps to the upside and is failing to give you a body close below here. EU, not a lot of imbalances on the upside, but EU is committing to closing below here. Usually, when you have candle closes committing to the low, when lows are being taken, the assumption is that between the old low right here and the closing price of this candle, there's going to be an imbalance. All right, so that's going to be the focus. The focus is the old low and the closing price of this candle that closes below the low. Here, between that portion here, let me put a box around it. That's going to be an imbalance right there. If that's an imbalance and EU trades and closes above that imbalance, doesn't have to be the next candle, but we're just talking about the fact that it does. When EU closes above this imbalance, there are two things that you should expect. One, this up candle is very likely to be a bearish order block if price is trading low, right? So in cases like that, if it's going to be an up candle or a bearish order block, you know what you want to see to validate a bearish order block. You want to see price trading below the low and retest in quotes and then continuing low. Now let's go over to GU. When GU is taking the low, is there an imbalance right here? No, there's not. There's not an imbalance right here because they're accumulating below the lows. So if there's no accumulation, you're likely to see the imbalance take place and price continue going low. If there's an accumulation, you're likely to see a small range, which can be denoted by a small day or a small range candle. Either way, we have a small range right here, and then take a look at the candle that forms right after. We have yet to see a candle close below here, but we're getting possible bearish order block candidates being formed. So that tells us when price trades below this candle low right here, the imbalance that we're waiting for happens here. So that might be a little bit to digest at first, but jump back to EU. We're looking for the candle that closes below the low. We're looking for it to create an imbalance. Once the imbalance is created, we're looking to see how does price trade around that imbalance. Here, imbalance is created, we closed above. If this is going to be a bearish order block, it has to take the low. It doesn't take the low, which means that the probabilities of price staying between the blue lines is very likely. That's what we have right here. Yes, it correlates to smaller time frames as well. For GU, here we do not have price closing below the low. So because price is not closing below the low, we expect accumulation at the low. If it's accumulating, at any lows, or you can take a look at any price action low. When they're accumulating at low to go higher, we have wicks going below here and no volume being committed. Here we have wicks, no bodies going below the low. They're accumulating inside here. Price is ranging. That's why we outlined this candle with the blue lines as the likely range where price is going to be consolidating in, versus EU, where I paid attention to the bodies itself, because there's more volume in this body. GU consolidated inside here, trades up, then it runs low. Since we have now finally closed below that low, that's the imbalance, and that's the area you expect price to either trade back up, create a bearish order block, and then push low, or trade back up and invalidate that area. So now when we take a look at this here, we have the imbalance. We have the imbalance being filled. There is no bearish day right here. Well, sorry, there's no bearish order blocks being created right here. So this is saying price is likely to be trading down to fill in imbalances created inside right here. For some reason this feels like it ties into order pairing. Yeah, they're all tying, luckily. So if we are looking for where are the imbalances that this guy could be trading down to inside this wick, all we have to do is jump to a H1 chart and we take a look at that low to all the way up into the imbalance right here. Look how it perfectly fills it in. So in this run up, if you take a look at it, this is engineered efficiency. So we drop to our H1 chart to look for imbalances. But when we get here, just take a look at this price action. Overlapping wicks, overlapping wicks, overlapping wicks, all the way up. Every imbalance created was filled in. So if this is supposed to be trading lower for an imbalance, and you're not seeing an imbalance here for it to target, what is price going lower for? We have the last down candle, then a push to fill in this imbalance. So whenever there's a higher or low that fills in an imbalance, automatically we know that it houses liquidity. If this sweeps the buy side liquidity resting right here inside the imbalance, and now we're trading low, what's the market going for if there's no imbalance? Liquidity. Now where is the liquidity here? If there's no imbalance inside these lows for the market to grab and then push, the liquidity that we're looking for is sell side liquidity resting below the lows. Again, that might be a little bit hard to grasp, but let's look at gold daily. If you remember when we're looking at gold daily here, when I had mentioned, take a look at the range between this arrow and this arrow. It's all efficiently traded except that portion right here. If that's the case, price should trade up to seek this imbalance since there is no imbalance above here. If it closes above here and starts pushing, this is the first area of liquidity to pay attention to, because that's a short-term high. That's a daily high. That's liquidity. But again, because I believe we're going to be bullish in September, all these daily lows and the discount end of the daily ranges should be where price is drawn to, because large bullish price actions either start in discount or they start when sell side liquidity is being paired. So all of that run down, which is also why we had that X tagged. Tag that X because after this swing low, this is the next low, which is a failure swing. That's the liquidity that they're grabbing. This point in time, it's still grabbing liquidity. Now, Here's the next part of correlated market analysis or intermarket analysis that you have to factor in. This guy. When this guy is clearly one-sided, you expect daily liquidity runs, imbalance fills, all that good stuff. If this guy is projected to be consolidating, and we did, I went as far as to anticipate that it would stay inside this box. And it's embarrassing me greatly. If this is going to be consolidating, that means that most daily charts are going to have a larger amount of wicks. Because if this is consolidating, the pairs that should move, based on my understanding, should be cross currencies. GJ is the only cross pair I look at, and it's garbage when it's garbage. So we have to move into markets that are going to move. So if you take a look at this, we're still expecting lower prices from this guy. But now, if you look at the old lows that it's trading to, someone's in chat. We'll get to that in a second. When you look at the old lows here, this is now the candle that's closing below the lows. This is also the area that we expected price to trade to. Now, just like the projected high of the month, I thought would have been 13,500. And we had a little bit of sweep. This is where I expected the low of the month to be at this red line. We had a little bit of sweep. Now, take a look at the difference between this sweep and this sweep. This sweep is above, I think it's about 200 points or 100 plus points above big figure or mid figure number. Then if you watch the candle wicks and bodies, you'll see that it's all accumulating around that 13,500 level, and then we crashed. This level, that red line, is just above institutional big figure or mid figure, 12,500. And again, we swept that here, and then it's playing around. This is another one of the reasons why on Friday I was saying 12,680 is very likely to get run. So don't look at buying retracements, because once they get below 13,000, the liquidity that's resting right here below these daily lows, this old high, and that institutional level are all going to draw price lower. So if they're drawing price lower, as I said to some of the guys, the wind is in that direction. If you want to trade in the direction of the wind, you're very likely to get a better setup. But once you start going against this, you're going to get crushed. Like that slogan on the group, you can't direct the wind, but you can adjust the sails. So the wind is blowing that way, adjust the sails and you have a tour. But institutional mid-figure level right here is where price was drawn to. Now take a look at AU, same idea. We expected that run back up to 0.7 institutional level, started a push, then price is trading low. If price is trading low, where's price being drawn to? Naturally, all imbalances, all retracements seek imbalances, but this imbalance right here at the red line that we're looking at is housing a lot of liquidity. So we can see how the market's sweeping inside those to grab liquidity. So with DXY consolidating, this is to be expected. Lots of wicks around the daily charts. We've seen this guy playing around since last week, so I've left it alone. Gold lower because the liquidity is inside here. These are the two order blocks that started that big push up. So for me personally, this is, it's a scalper's market. Once the market's consolidating, you have to look at scalping, because there's not going to be a lot of sustained move in one direction. And even if there is a large move in one direction, it's usually a stop point or a high time frame stop point. So you don't want to commit to a stop point direction and then the market trades back against you. S&P 500, Same thing. So as a trader, these are times when you have to understand that it's better to relax. Yes, there are going to be setups forming every single day, but is it worth the risk? This week is NFP. Tomorrow is the last day of the month. At the last day of every month or the last week of every month, there's always an influx of volatility because persons are rushing to exercise their contracts. Question in the chat. How did you project that on USD index? Just pay attention to where the daily chart is drawn to and trade that direction on lower time frames. Confluence, I was going to consolidate. If the market's drawn to a particular liquidity pool and there is no imbalances close to that liquidity pool, and we're at a time when the market is not likely to move, all of those things are saying it's going to run here and stop. So for DXY, it's going to run to the liquidity pool, then stop. September starts I think it's the last month of the quarter, I believe. If that's the last month of the quarter, then again, quarterly expansions, quarterly expirations, they're all going to start and end there. Which means if the next quarter is to be bullish or bearish, September usually creates a setup. So what am I expecting? I'm expecting price to trade back down inside here. If it gets to this level right here, I make my next decision. Are we closing below? Are we taking out this candle, which is low right here? Then I want to see lower prices, and I'm thinking 105, 103, 93. But if we can't get down here, I'm not going to hold on to a bearish bias and then try to, buy EU or something like that. You have to include something in your analysis that says it's not going as planned, walk away. You don't always get the chance to switch a bias. So let's say I'm wrong about DXY going lower. What would I be looking for to change my mind? Well, this is still open. This imbalance is still very much open. The fact that we're consolidating at an old high suggests that we can very likely have a spike out of this consolidation because smaller ranges usually leads to larger ranges. We've already gotten this spike down, followed by this push to the higher, this push to the highs. I'm thinking of this as a failure swing, and this is a liquidity run. So now for me, there's a whole lot of liquidity built up right at that low. Let's tag that with a X. For liquidity purposes, I'm thinking this is where liquidity is. Do I have anything here that suggests that the market is likely to trade lower right now? No, not on this time frame. Because if it's an impulse that's going to push low, they usually start right after grabbing liquidity, or they grab liquidity, create an order block, retest the order block, and then push. If you're looking at any of these candles for an order block, I'd be looking at this one right here. We have not, well, besides the failure swing, we haven't stayed or traded below here. That's a failure swing, that's opposing liquidity run. If we drop back below this candle's opening price right here, and then come back up, I'm ready for this guy to go low. In that order, below the opening price of this candle, tap, then I want to see low. If anything happens that's not that, and I really don't care what this is doing, I can sit 2-3 days and wait for my trade to form, because when you do that, you don't give your edge away. My edge is my model. So if my model doesn't form, doesn't matter how many bills or obligations or whatever is stacking up against you. If you can't find a high probability setup, don't trade. Because going into the market with the idea that I need to make money, but I'm not going to find my high probability setup, is only going to lead to disaster. No other way. Question in the chat. Can failure swings to opposing stop hunt become a dealing range? Yes, 100%. How do you determine if a failure swing to opposing liquidity run is a dealing range? Did the failure swing take liquidity, and did the opposing liquidity run take liquidity? The opposing liquidity run by definition must take liquidity. So this high, well, not this high, these highs were run here, buy side liquidity taken. Did this take sell side liquidity? If it did, if it took sell side liquidity, then buy side liquidity, you fib low to high, then you watch discount arrays. Are we coming back to discount arrays and failing to close below them? Then that's going to suggest higher prices. But if this takes sell side and then this takes buy side and we trade below this, that is automatically suggesting that when price is coming back up, because it will come back up, that's going to be a retracement to go lower. On NAS, can we say that the dealing range is from yesterday's low to today's high? NAS, let's take a look. On this time frame, I don't see it. On this time frame, I don't see it at all. Hourly chart. Nope, can't be. This is not a dealing range. This is all a retracement. Remember, Friday was a huge move down. Huge move down. These were the relatively equal lows right there. So if we take the idea that we just talked about and transpose it to a lower time frame, this is the candle that closed below the relatively equal lows over here. The imbalance that was created right there, we've already traded back up inside that. Here, then we push lower aggressively. So for me to entertain bullish ideas for this guy, that high, which is this candle's high, which can be extended to mean that line, we have to get a daily candle closing above that. How do you form setups after huge runs like that? So if this is a huge run low and I'm looking to go long for whatever reason that may be, I'm looking to go long. I'm looking for lower time frame market structure shifts. So let's go to 15-minute chart. I don't really use this time frame, but why not? Let's go to a lower time frame 15-minute chart and take a look at market structure shifts. There are many definitions for market structure shifts. Let's use the most classical one of them all, which is price trade number of a previous high. So let's peg 12,500 as a previous high and then watch when price closed above that 12,500 here. At this point in time, at the close of this candle, that's a market structure shift using the classical definition. Yes, there are moves that you could have gotten before, but that's not the focus. This candle right here at 9:30 on Friday, no, when was it 29? Yesterday. That's a market structure shift. If the market structure shifts to bullish right here, right there, really don't want to decorate my H1 chart, so I'm going to use the annotate feature. If we had a market structure shift with that candle right there, because it trades above previous high, which would have been this in that case, I'm looking for between that point and the low between these two highs. I think this looks like the lowest low. Between those two levels, where was the last time we had a stop hunt? In order for me to find that, I need to look for after this point, since in this case, it's not the lowest one. When did price trade below a previous low? We didn't have that until ever. I guess until in here. This was the last time we had lows and then price traded below it. When that happens, I'm thinking this right here, or that low right there, That's an internal stop hunt. This was the low, and there's a push. So the retracement right there should target two things. One, between that and that, where are my discount arrays? Where are my internal liquidity pool? How was this run done? Because type 1, type 2, if we had one big candle, then I'm thinking OTE. If we had bam, 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 then I'm thinking liquidity is resting right here. So sweep higher. What's my view on the XY from an intraday perspective? All right, this actually segues into a conversation I was having last night with the group. What is bias? Why is it important? Is bias linked to time, or is bias linked to a time frame? So if your weekly chart is bearish and your daily chart is bullish, are you going to stock longs or shorts? So weekly bearish, daily bullish, are you stocking longs or shorts? You have about 6 minutes shorts. So the day is bullish, but you're stocking shorts. Interesting. Weekly is bearish, daily is bullish, so you stock shorts. That's interesting. Nobody else wants to put their neck out and say what they think. Longs, I would stock longs too, because I am not a weekly profile trader. I am not a higher time frame swing trader. I'm a day trader. I trade the daily delivery. So every day my bias is, what is the daily time frame doing? What's the daily chart doing? Where can I get involved? But being realistic, we know that the higher time frame is bearish. So if this is the daily time frame, so in this case, NAS daily time frame is bearish. Huge push down. That's a bearish delivery, which means runs higher are likely to be retracement unless they're going above the start of the bearish push down. So let's say this is NAS right now, and this is what we're having. All of this is permitted. This is a retracement. What to focus on? The imbalances in this price swing down. So if you take a look at all of that on NAS, where are the imbalances? Imbalances here. Small imbalances inside here. So if you project that price out in time, hopefully this is straight. That should not surprise you. It really shouldn't surprise you, because IZT core content is now on YouTube, month one, elements to a trade setup, retracement seek imbalances. That's an imbalance. So at the open of the day here, you don't open the day and start being bullish. We're waiting for a market structure shift. Market structure shifted here. At that time, see, at that time, I'm interested in this price, which means even though I'm expecting price to retrace, I'm expecting it to retrace to bullish arrays or sell side liquidity, and I want to see moves higher. If price creates imbalances, then all of that is permitted. If this is a time of the day when price is not likely to be favorable for my trading, then I don't care what retracements are there. YouTube video structure forming, right? On AU, what time frame? M15. AU M15. So we have push, high broken, project opening price of this candle out in time. Do we have price rejecting that area? We don't know yet. This delivery in particular has imbalances above. From that candle's high down to here, we can have retracements inside this. In a perfect world, it's just gonna tap this and move low. But because there's an imbalance inside here. Let's try that. There is kill zone. What about time, sir? Kill zone is a segment of time. That's what it is. Time, however, there's kill zone trading and then there's time and price trading, right? Two different things. Time and price trading is precise to the T, to the letter. It's very, very precise. It suggests that at certain time of the day, price is likely to either run for liquidity or imbalance. You pay attention to those. So this wasn't a fancy how to get in, how to get out call. It's something that you can implement in your future analysis to help you understand when a move is likely to form. What do we do in case of imbalances? We wait. Imbalances are like weekends. You don't do anything on price until price gets back. Just relax and wait. Daily chart on AU, nothing spectacular here. No FEG below liquidity means we attack lower liquidity. That's an interesting statement, a very interesting statement for many, many reasons. If we have liquidity here and the FVG is below it, usually, depending on the market structure, that FVG becomes fair value for buying. If that's fair value for buying and there's a specific delivery we want to see, like this is still seeking sell side. I'm not convinced that price is done working this because of this delivery. It needs to happen in a specific order, and that's not yet happened. So this opens the door that this needs to go lower. So to blend that with intermarket analysis, if I'm looking across peers, not cross peers, but across peers, and I'm seeing a need for this to go lower, and I'm not sure what this is going to do, that automatically tells me this is likely to trade higher. You blend that across time frames or across peers. If you can make a case for other peers needing to go lower and you're unsure about DXY, it usually suggests that DXY was going to push higher. So even though this was what we framed, as we got closer to this day, it became obvious that DXY was going to push higher because this hadn't gotten to where it needed to be. This hadn't gotten to where it needed to be. GU and EU are still playing around. So that's something you could factor in. But call is about to end. Yeah, need to do more calls like this or just talk about stuff and not how to get in, how to get out. Enjoy the rest of your day, guys, and we'll talk in the group.